What we're going to go on today is figuring out how I got to this building being worth $9.5 million. Okay, why? How do I know that property's worth $9.5 million? Well, here's how. We're going to break down these numbers for you guys right now. Okay, so let's pull that back. And we're speculating, we're underwriting this deal, and you say, okay, this thing's going to take me a year to entitle, a year to build. Okay, and this is why I'd rather build 100 units than 50 units, because really the amount of work is identical. The amount of work that it takes to go in and entitle, permit, and build, essentially get building permits to build 50 units is going to be exactly the same as what it's going to take to go out and build 100, 120 units. But the value goes up substantially, your time. So you start thinking, okay, it's safer. I can afford this, or I think I can afford this. And so the reality is you put a viable 120 unit project together, it's still going to be just as easy to raise the capital and build that 120 units as it is the 50 units. But for a lot of people getting started, they can wrap their head around a little bit smaller build. So 50 units is what we're going to do. But you guys will learn why I actually go in and I actually build over 100 units when I go in and build and underwrite stuff, because if I'm going to put the work in, I just want to make larger profits. But still, a $2.5 million profit, even if it took you 2 years to do this project, that's a great profit. And so let's see how we get these numbers. So we have a 50 unit build, okay? So we got 50 units. Now, in those 50 units, let's say we have an even spread. 25 of them are one bedroom units, and let's say those one bedroom units are leasing for $1,600, okay? Now, remember, one thing that's really important to understand about what we're building here is we're building affordable housing nationwide. So we're building a Class A product that competes with Class B rents, okay? So we're not going in and we're not putting swimming pools, big fancy gyms. We're not putting croquet courts in over there. We're not putting in all the extra amenities, right? We're not going in and putting squash courts and stuff like that, and tennis courts and all of that. We're going in and we're doing simple builds. So we're building a Class A product, but we're competing with Class B rents because we want what we're calling affordable housing. Okay, we're wanting to create a product, an asset class that even if the market turns and we're sitting in a compressed economic market, people can still afford and can still rent. So the Class A's, where a similar product is renting for a one bedroom at over $2,000 a month, someone can come in and save themselves $500, $600, $700 a month and rent for $1,600 a month. A family that's renting a two bedroom apartment where they go in and they're leasing a two bedroom for typically $2,500 to $3,000. Good morning, precious. My daughter gets embarrassed. So when they're renting for $2,500 to $3,000, they can go in and save $800 to $700 or so out a month and pay $1,850 a month in rent. Significantly more affordable. Why? Because now they can take that money and they can make a car payment on that, right? Now they can make their apartment payment, their house payment, and their gym membership all for the exact same cost they were paying just for their apartment. And so when the market compresses and people's incomes get restricted and the cash flow slows down, that's when it becomes super important. But not only that, it's a model that more people can afford. So the people that are working at the Walmart stores, the people that are working at the post office down the street, the people that are working at the grocery store or the restaurant right down the street, those are the people, working class professionals, the median, those are the people that are renting from us. And so we could go in and let's say we have 25 units renting at, so the one bedrooms, 25 of them are renting at $1,600 a month, which is pretty cheap for new construction. But we'll just do it at $1,600 a month. And then we have the two bedrooms that are renting to, these are beds, that are renting for $1,850 a month. Now, we can agree that the average rent is probably right around $1,700 a month, taking these two numbers. So you take $1,700 per month on average, okay, for average rent. Per unit. Now, we have 50 units. You do a multiplier, and we're going to take the gross income potential. So your GIP, your gross income potential, that's what the property potentially can lease if it's 100% leased. Okay, so your gross income potential, you multiply $1,700, and I did the numbers in advance so that way I'm not fumbling through the calculator, because I don't care how good you are at underwriting. When you're working through this stuff in front of a camera, I'm trying to entertain, I'm trying to talk to you guys, I'm trying to record a video, I'm trying to punch in numbers. Alec and I were doing this last week, and I was sitting back going, oh, darn, fuck, shit, man. And I'm sitting back going, fumbling through a calculator, trying to write this stuff, trying to entertain you guys and explain it to you guys. I said, you know what, give me 5 minutes, Alec. Let me just write these numbers out real quick, run through them so we can get these guys actual numbers. I can focus on what we're doing and give you guys real numbers and real information. So our gross income potential is $85,000 a month times 12. So that's going to be 1 million. So we're going to have $1,020,000. Okay. How did we get that number? Some people are sitting back going, oh my God, how'd you get that number? I took $1,700 on average. That's our average. Okay. That's our average. I'm going to multiply that times 50. There's 50 units, right? So when you multiply $1,700 times 50, that's your number right here. Okay? Well, it's 1,700. Your number is actually 85,000, but then you multiply that times 12 months. Because when you're doing gross income potential, everything's done on an annual basis, okay? So all the numbers that we're talking about right now are not based just on a monthly basis. They're based on an annual basis. That's how taxes are done. That's how income is derived. That's how prices, the price point model on real estate is all derived. It's all based on an annual basis. So you take 1,700 times 50, that gives you a number of $85,000. Then you multiply the $85,000 times 12. That's your annual. So this is your annual, okay? Okay, so your gross income potential. Now, we take our gross income potential and we're gonna go ahead and multiply that by 95%, because in apartments, there's a revolving door of about 5% every single month. Okay, so even if you're at 100% occupancy, you're typically revolving about 5% of your doors every single month. Now, there is times you're going to collect 100% of that rent in a market that's like today's. But let's underwrite it for the real world on more of a sedentary basis, where the market is actually working the way it typically does. And most apartments are going to run it. Any good apartment complex is going to run it 95% occupancy. It's new construction, right? So we don't have to worry about leaky roofs. We don't have to worry about someone saying, hey, your apartment complex is junk. We don't want to live here because there's mice and rats and leaky roofs and peeling paint and ugly floor tile and stuff like that. Everything's new. So we function on a 95% occupancy base. You take your gross income potential. Okay, so you take your GIP and you multiply that times 95%. Okay, that gives you your gross operating income. Okay, that gives you your GOI. So your gross operating income, when you multiply that out, is $969,000. This is what your property brings in per year. Now, this is assuming that you don't have trash service. This is assuming you have no late rents. This is assuming that you have no credit checks for your management company. Because ladies and gentlemen, here's what's cool about real estate, and here's what's cool about apartments, is that it's not just this number right here that you're adding up. This is your gross income potential. I'm just doing it based only on the unit cost that people are paying rent. So understand that conservatively speaking, we're underwriting this deal assuming that there's no covered parking, so you're not charging people an extra $50 to $100 a month for premium parking spots. You're not charging people an extra $50 a month for trash service, where they put it out their door and a guy runs by and picks it up every Tuesday morning or whatever it is and takes it to a dumpster for them. This is not assuming that people are not paying a $75 credit check every month for new tenants that are coming in, which they are. This is assuming that they're not paying for late fees, which people are paying late fees. So this number will go up substantially. And so what we'll end up doing is seeing a number probably closer to about like $1.2 million or $1.1 million. But we're going to underwrite it based on the unit rents only for underwriting purpose, right? This is only for underwriting purposes to make sure the deal works, because we want to make sure that we have something that's really viable in today's market. So we have a gross operating income of $969,000 that property is bringing in just based on the rents. Now, we're going to go in and get our net operating income based off of this. So how do we get our net operating income? Well, we have to subtract all of our expenses. So if we go in and we say our expenses, most apartment complexes, most commercial real estate that are multi-unit real estate, there's management that takes place. There's either a management company you got to pay, plus facilitating, mowing lawns, landscaping, trimming, blowing, snow removal, all that stuff, leaky roofs, toilets, light fixtures, light bulbs, broken stoves, broken toilets, all that stuff. Now, this property's brand new. Is there going to be expenses still? Yes, absolutely. But our expense cost is going to go down a little bit because it's a new property. Not only that, our expense cost is going to go down based on the fact that it's just a simple garden-style apartment complex, 3 stories max, no elevators, no swimming pools, no grass, maybe some artificial turf, but xeric landscaping, real simple to maintain. And so where the average property takes 40% to manage, we could probably manage this property at about 25% to 30%. But again, we're going to underwrite this conservatively because we want to make sure that our numbers work. And so we're going to underwrite this saying our expenses each month are 35%, even though I know we can underwrite it for less. So if we take our monthly expenses at 35%, our management fees and maintenance, our expenses at 35%. So maintain and manage, we're going to do 35% of gross operating income. That's going to be $339,000. 150. Okay, so that is that's what it's going to take to maintain it every single year. Essentially $340,000. Okay, now property taxes. Take about a 1%, 1.2% nationwide, we're going to have about $110,000 in property taxes. Okay, now where did I get that number from? Property taxes, I'm evaluating it based on my speculated $9.5 million resale number. Okay, the bank, we go in, we talk to the banker, we talk to the brokers, we see what these properties are going for right now based on cap rates, and that's what we're underwriting right now is the cap rate to see where we're at. Now, most stuff is selling for sub 4% cap rates, meaning that less than 4% cap rates, like a 3.9% cap rate, 4% cap rate. We always underwrite things closer to that 5% cap rate mark. So let's see how we do doing this. So we take our maintenance and management fees, $339,150. We take property taxes of $110,000. We're going to take our insurance of about $60,000 a year. Now, these are annual costs, right? Property taxes get billed annually. Insurance, liability insurance, property insurance. You're going to pay at least $60,000 in insurance on this property a year. Now, premiums are up a little bit right now, ladies and gentlemen, because anytime we have natural disasters, storms, and insurance companies are getting pounded because of natural disasters that are happening, tornadoes, like that we saw. Where did we see those tornadoes? That was Texas, right? That they hit, and we saw a lot of we saw hurricanes and stuff that hit the coast this year. So anytime we have stuff like that, insurance premiums go up, or at least that's what they tell us, right? So $60,000, property tax is $110,000. Now, our net operating income, okay, and we're going to just take this number. So our net operating income, if you add these numbers up and you subtract them. So how do you get your net operating income? You take all expenses and you subtract them. So we get our NOI. Hey, Alec, can they see this right here? Can they view that in the camera? Can you get that in there? Good, okay. So our NOI is all expenses minus, it's our GOI minus expenses. So we get our gross operating income minus expenses. Okay, so our net operating income, or gross operating income minus expenses equals our net operating income. So we add up all these numbers, we subtract them from this number right here. That's going to give us a number of $459,850,000, or $459,850. So we have, so that's going to be 459,850. Okay, that's our net operating income. That's our NOI. So let's get a clean page here. Okay, so net operating income is derived by our GOI minus expenses. So our NOI on this property is $459,000, $850. Okay, that's our net operating income. Now, we want to figure out our cap rate. So to get our cap rate, we're going to take our net operating income and divide that by our property valuation. Okay, so we said that our property valuation is $9.5 million. So we take 459. So we're going to do cap rate equals NOI divided by price of property. Okay, so you get your cap rate, capitalization rate is your net operating income divided by the price of the property. What did we say the property was speculated to be worth? $9.5 million, right? So if we take $459,850 and we divide that by 9.5 million, okay? What does that number give us? If you divide that out, that gives us a 4.8% cap rate. So that number comes out to be, you're going to see it in a decimal point. You got to move over your decimal points, right? So it's going to be a 4. Okay. Now, ladies and gentlemen, that's close to a 5% cap rate. Things are selling for sub 4% cap rates. Are we safe? Can we realistically say that this property is worth $9.5 million? And the answer is yes. We could sit back and say, okay, I can build this thing out. The current valuation is going to be $9.5 million when I'm all done, based on the numbers that I can get for rent. How do we know we have those numbers? How do we know that those numbers are truly viable? Like, did we pull those numbers out of the pie in the sky, or did we get them from someplace? Well, where we get these numbers from is we talk to the professionals in the industry. Where we get these is from comps. And so where they come from is you sit back, you go to the commercial brokers that deal in multifamily in that asset class. So you talk to a Class A multifamily broker. You talk to a Class B multifamily broker and you say, look, I'm going to build this asset. If I built this asset in this area, compared to the other apartments in that area, what are they currently getting for rents right now? What are the current, what can I realistically rent this for? And they'll say, you know, Jerome, there's a property on 130th Street, and there's a property on Lincoln Avenue, and there's a property on Carmel Avenue, whatever the street name is. This one's renting for this much, but this is more of a Class C property, maybe a B minus. There's another one renting for this amount. This one's a Class A that was built 3 years ago, and that's renting for X number. There's another asset class that's garden style, but it's Section 8 housing. It's renting for this amount. And then you take a conglomerate effort of everything that you have in the area, maybe nothing exactly like yours, but pretty damn close. And you get lease rates. You say, and the broker tells you, realistically, we can rent these for $1,700 a month. We can rent these for $1,650 a month. We can rent these 2 bedrooms for $1,850 a month, conservatively speaking. And rents are set to push again another $100 a month on an asset class just like this. But I don't sit back and go, oh my God, I'm going to keep my fingers crossed and underwrite this deal just in case I can get an extra $100 a month and squeeze numbers. I'm going to sit back and say, okay, what are today's numbers? Because if I can underwrite it in today's numbers and that rent push goes up another $100 per unit, this property might be worth an additional $1 million at the end of construction. How cool is that? That just happened to us on our Phoenix project where we underwrote them in $900 a month rents for one-bedroom apartments, and now those things are pushing over $1,300 a month. Our property went from a $17 million valuation to a $24 million valuation that fast just because of the rent push, and we underwrote it at $900 a month. Are we sitting in a really good position? Yes. And so we want to go in, and like I mentioned before, when we're underwriting these deals, one of the big things is I underwrite them conservatively. I'm only utilizing the rent. This number is going to go up. Let's just go theoretically real quick, and I'll end on this. Look, let's say theoretically you got 50 units. Let's say that out of those 50 units, let's say that 47 of them are leased, okay? Let's say that 50% of people took advantage of one or two amenities, okay? And the amenities each average 50. Now, what amenities do we have? We probably have maybe some covered parking. Maybe not, maybe. But we have, let's say that we do 20 stalls or 25 stalls of covered parking on that property. Now, we go in and we charge, let's say, $100 a month for covered parking, okay? Let's say that we have trash service, and we're charging people $50 a month to dump their trash once a week or twice a week on maybe Mondays and Fridays. We go in and we offer trash service. So we pick up from the weekend, we pick up at the end of the week, and we offer a trash service. We go in, pick it up off their doorstep, and we take it to the dumpster for them so that they don't have to. A lot of single women living alone or elderly people, they like that amenity. Or just millennials that are busy and people are working, they don't have time, they can just easily throw it out their door, and it's a convenience deal. Let's say that's $50 a month. Let's say that we offer an in-house laundry service or whatever it might be. There's a lot of things you can charge for. But let's say that we're getting an average of $75 a month from 50% of our tenants. So if you go in and you lease 47 units, so let's say 25 people every month are paying an extra $75 a month. That increased your monthly cash flow by $1,875. Ladies and gentlemen, that pays for something. You multiply that times 12, that's an extra $22,500, okay? So we could potentially add, let's do this in black because these are going to be our additional things. Let's say we can add an additional $22,000 just in amenities. Okay, now I'm just giving you guys ideas. This is just for idea's sake. This is so that when you guys go in, you think about this stuff, you sit back and go, damn, this is pretty cool. I'm underwriting this based on rents, but I have the potential to make more money. I have the potential to have a 7% cap rate, 6% cap rate, where I was underwriting it closer to 5% just based on stuff, right? So every person, if we have a 5% attrition rate every single month, and so every single month we have 2.5 units. So let's call it every month we're taking, and there's going to be people that are denied. Let's say we take only 3 applications a month because that's all we have available. Okay, so we take 3 times, and we haven't even taken into consideration that when we opened this property, we had to take 100% of those $75 credit checks. So 75 times, let's do it by 5. Okay, so times 5 applications a month. That's $375 a month times 12 months. That's an extra $4,500 a month on credit applications. You're going to get a lot more than that, ladies and gentlemen. But let's just say $4,500 a year. So we're going to add it in credit checks or credit apps, another $4,500 a year. Okay. Now you're going to have late fees. Let's say that only 10% of people pay late. We get a lot of lates, ladies and gentlemen. And I'll tell you, if you have a management company doing it for you, it's best, because if you're like us, what we do, and when we manage our retail, we're forgiving because we deal with a lot of mom and pop shops. I shouldn't even tell you that. I remember Sean Maloney got mad at me one time and said, Jerome, you're a professional. You shouldn't tell people that you're not charging people for everything. You should be telling people that you're charging everybody everything and you're doing it to a T. I'm going to sit back and tell you guys the real life reality, right? I'm a badass in what I do. I'm good at it, but I make so much money. You gotta figure, okay? What is your time worth, right? So I run a full-time construction company doing millions upon millions of dollars in business, or do I go after a $100 late fee when I have girls in the office? So I sit back and I go, if I have to pay somebody in my office $50,000 a year to collect late fees, but I'm only going to get $20,000 a year in late fees, is it worth it? right? So there's a point where you sit back of diminishing return, where you sit back and go, what's the value? So I sat down, I talked to Sean. The reason I'm not busting Sean's balls or anything, I'm just telling you the reality of he was telling me. And I got what he was saying. I was saying, no, you're 100% right, Sean. But the reality is, I said, is that when we manage, I'm not the best property manager. We're not even, I don't even consider us a property management company, but we still own 11 retail buildings that are small retail buildings, anywhere between 8,000 square feet and 20,000 square feet that we still manage each and every year. The rest of them, all my other properties, are managed by property management companies like CalCap and other companies. So I'll tell you guys that the 11 buildings that we manage are managed well to underwrite the leases and retain good quality tenants. But I work with them. A lot of them, 80% of our clients are not national tenants. About 20% of them are national tenants, and about 80% of them are small, local business owners. And so I don't try to nosebleed them. I work with them a lot of times. And yes, the income potential from those people can increase and grow if I did a better job nickel and diming them on late fees. But I just call them, I'll tell the girls, can you do me a favor? We haven't collected rent from blah, 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 boom, 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 boom. Or they'll tell me, one of the girls will tell me, then I'll tell one of the other girls like Tammy that deals with that stuff. I'll say, hey, we haven't collected rent from this church, this salon, this, whatever it is. I said, give them a call, tell them if they pay by today, then we won't charge them any late fees. If they pay by Friday, we'll only charge them a $50 late fee. But if they don't pay by till Monday, I'm charging them all their friggin' late fees. Okay? So all of a sudden, we get a bunch of people coming back to the office just dropping off rent checks. Because ultimately, what do I want at the end of the day? I want rent checks. I just want my rent checks, right? Like, just give me my rent checks. I'm not here to nosebleed you. Just pay me my rent checks. I don't want to fight with you. I don't want to argue with you. I want you here long term. I don't want you to think that I'm a jerk. Just pay me my rent checks. I'm gonna work with you because I like you. I love you. I want your business to succeed, and I want you to continue doing business with me. And I don't want to have the hassle of dealing with new tenants that suck. Okay? I have good tenants. I want to keep and retain my good tenants. I want to work with them. I want to do that. That's how I got through the recession, ladies and gentlemen. I worked with people. You know. So the reality is, I work with people if they work with me. But when they stop working with me and they become a pain in the ass, then I'm going to bleed them, you know. But when I have a property management company like CalCap and these other companies, that's what they do for a living, and I'm paying them a fee, a handsome fee to do it, I expect them to collect all late fees. And so it's different with residential. I want all late fees paid. So people are going to come in, and let's say that you have, out of 50 units, let's say that you have 7 of them, or 6 of them, you'll have like 6 or 7 of them paying late every single month. So let's say that you get another $75 times, let's say like 7 people every month, times 7, times 12 months. That's another $6,300 in late payments every single year. So just in late pay, so your late pay, you're going to get another, was that $6,300? $6,300. Okay. Now, ladies and gentlemen, you're going to have other stuff that you can charge for. There's going to be other income potential. Oh, your laundromat. If you own your washers and dryers in your laundry room, you're going to generate income from your laundry. So you're going to have, you know, let's say the average person spends $10 a week on laundry, and let's say that most of your tenants are doing laundry there since if you don't have washers and dryers in your units, or let's say that actually only 20% are using it, but 20%. So you have 10 units. And they're spending an average of $10 a week on laundry. Times 10, that's $100 a week. Times 4.3 weeks in a month. Times 12 months in a year. That's $5,160 a month in laundry. So you're going to have laundry service of $5,100 a year for laundry. Okay, you getting it? Okay, so now you just took your bottom line where you have 5,160 plus 6,300 plus 4,500 plus 22,500. You just added $38,500. So you just added to this number right here, plus you're over $1 million now, 38,000. To your gross operating income. Ladies and gentlemen, that number is going to roll downhill because we already took our maintenance fees, we already took our property taxes, we already took all these expenses. So this number is going to roll down to your net operating income. So if you take your net operating income of $459,850 plus $38,500. That just brings your net operating income up to $498,350. Okay, so let's redo these numbers real quick here. Let's just see what that does to our cap rate. Okay, I'm curious too. So we're going to cross out that number. Our new net operating income is going to be $498,350. Okay, that's our new NOI. Okay, so we take our purchase price. We take $498,350 divided by our speculated $9.5 million, right? That's a 5.3% cap rate now. So that takes you up to a 5.3% cap rate. That probably just raised the property value of your property by close to $500,000. Ladies and gentlemen, that's the reality of real numbers on real estate. Okay. That property is now probably worth closer to $10 million just based on that alone. That's pretty cool. So, ladies and gentlemen, this is the potential. This is the long-term goal. So you go out, you buy land, you build houses, you retain income, you get a resume, you start learning how to be able to facilitate construction management, property management. You start being able to get that money, put it in the bank. You don't go out and buy Lamborghinis. You don't go out and buy Rolls Royces. You don't go out and buy a big fat house. You go out and you open up a bank account. You take that money, put it in stocks. Then you borrow money against your stocks. Let your stocks go out. Get some stocks like Walmart, some ExxonMobil. Get some stocks that are making you some 2%, 4%, 6%, and even 8% dividends. Plus stocks that are strong, solid stocks that are growing up a little bit. You know, this year, people are making 12, 15, 17, 21% returns. Now, is the market going to stay like that? No. But what if you go in and you do a modest 12% return with dividends and on your stocks, and then you go out and borrow against your own money at 6%? You pay them back 6%, you're still making 6%. And that, ladies and gentlemen, I don't have a security license. I don't claim to be your financial advisor. I'm not sitting here to claim to be a CPA, an attorney, or any of that stuff. So disclaimer, all I'm telling you guys is how I do stuff. And I explained to you guys how I have leveraged my assets, my capital. I go in, I put my money into stocks. A lot of real estate people say, I don't own a penny in stocks. And I sit back and go, that's stupid. Why? Because I can take my money that I have, and when I'm retaining my money, I stick it into stocks. I'm making, you know, like this year, I think we're at just shy of 18% return on just our stocks on millions of dollars. So I made money on that. And this year, because we were in the interim phase, we haven't even needed to draw against that money this year. Now, last year, we drew against that money, and then I put it back by the end of the year, and I paid all that money back so I didn't have to pay it. So when the money comes back in, I stick it back into the stock market so that 6% stops. But then when I sit back, like this next year in 2022, I have so many projects coming out of the dirt, I'm going to need some of that capital. I have millions of dollars, and I'm going to say, okay, I need to allocate some of that capital. So I'm going to take it out on a loan against my money at a 6% interest rate or thereabouts. And then I'm going to take that money and deploy it into something else where I can go out and make a return like this, where I can make a $2, $3 million return, $5 million return, utilizing my money, and then I'm still making 6, 7% on the money that I borrowed against. And so I'm just double dipping with the exact same capital. I got my money working for me two different ways. Plus, I'm still out there running my business. So we have multiple streams of income that are pumping in through different streams, different avenues, and we're going out and we're building out stuff like this. Ladies and gentlemen, I think it's the smartest thing people could do. Why? I do it. You know, I won't tell you guys to go do something that I'm not doing myself. And so, ladies and gentlemen, this is how you go out and you buy land, build apartments. In a market right now where things are selling for sub 4% cap rates, you can come in, have $2.5 million to $3 million of equity. And if you stabilize it with this, you pull some of that equity out of your property at the end of construction, tax-free, and you still function at a 5.3% cap rate. That's pretty damn cool.